Hi, this is Ron Janish with andrewscourse.com, and in this video here we're going to show you a very straightforward and pretty much an easy way to outperform the market, effectively beating the performance of the S&P. So let's take a look at what our benchmark is and why. We're looking at is simply something that will beat the S&P in performance. So in other words, if the S&P goes up 20% during a time period, the performance of the portfolio would go up over 20%, or even if it doesn't, it would be doing that with much lower risk, much lower down moves. So in other words, a much better Sharpe ratio. Here's how this works. The theory is very, very simple and straightforward, that in a bull market like we have had for the previous several years, the S&P tends to come down for a few weeks and then continues upwards. And we can see that every time here it kind of goes down for 2-3 weeks and then goes up again, as a little uh, scary session, goes down, comes up again, goes down, comes up again. And there's something that we've noticed during these time periods when the market comes down that we'll share with you, that we implemented this earlier this year, and it's really worked wonders for us. Basically, the S&P represents 65% of the market capitalization. What that means in simple English is that if you take a look at what all the stocks in the US are worth, and you take about 65% of that value, that's the value of the stocks in the S&P. So the idea is that there's a whole bunch of subgroups in here, and that some of these subgroups might be, car makers or gold mines or fast food companies. And these subgroups are going up and down in their own cycle, which sometimes coincides with the S&P in terms of highs and lows, but not always. And here's a nice example of a subgroup. And we can see that this pattern here is totally different than the S&P. And this is U.S. broker dealers, for examples. So that might be companies like TD Ameritrade, or actually that would be under a bank. It might be, who's a broker dealer this way that's listed? I don't know. Scottrade, I guess. Anyway, so here's an example of a chart with utilities, and you can see, like in July of 2011, it went down nice. October of 2013, actually of 2012, this would be, it went down real nice, and here it just went up like gangbusters. Okay, so imagine if you were somehow able to take advantage of these sectors as they start going up in a super strong move. Okay, well, that's what one person does, I know. And what he does is he takes what is called the high risk ETF approach, or the high RSI ETF approach, rather. And what he does is he looks for high relative strength ETFs, and this isn't just relative strength in terms of the RSI index. This is relative strength in respect to each other. So he'll take 30 or 40 ETFs and kind of see how they're doing compared to each other. And he winds up not only outperforming the S&P, but he also winds up being short at times. And the reason is because what he's noticed is that sometimes some of these ETFs give him an opportunity to be long and short at the same time. So he might be long the broker dealers, and I remember he went short in what's called IYR, and this is an ETF in the realty fund. So one way of doing it is that where you can be long and short is by being long the strongest and being short the weakest. Okay, and then how much you decide to be long or short is really up to you. I noticed that during this time period, his performance on that particular portfolio was a little bit better than the S&P. about 10, 15% better than the S&P. Now, the benefit of that is that in theory, if the market takes some ridiculous tumble, that because he's short something, that these would wind up softening the blow, possibly. But there's another way of doing this. And let's talk about the other way. And basically how it works is this. After the market goes down 2 or 3 weeks, what I've noticed is that there'll be a conglomeration of buy signals. So what I do is I just monitor thousands of stocks on a daily basis, and I look at them for buy signals. And it just so happened that around the summer, around June, that I wound up getting a whole bunch of buy signals in the precious metal stocks. Now, this is an example of one, and this one had been going down for the longest time. So this gave a buy signal down there. So what I did was I looked at the various stocks that were in that group and wound up buying this one here. And after the price went up to this area here, and I think it went past there a ways, wound up selling it. Simple as that. So the idea is that this move here to here, which was probably about 60 or 70%, was as much as I might have made in the S&P. And believe it or not, the 60 or 70% was probably as much as, because I only take a percentage of my portfolio, maybe 20, 30, or 35% at the most, and put it into any one particular area. Okay. And in this case, it was this particular stock, and this particular one was paying some kind of dividend of 3 or 4%. Okay, so that was in SVM. That was in June. So once again, the stock market went down in August, and we were down in where were we? We were in Istanbul and other fun places, giving seminars and things. And I waited until I got back here, and we had a buy signal of all things in the fixed income group, and wound up buying bonds and took the ride here. And the ride here was only 7-8%, not real much. So, but considering the fact that this was done in futures, it was quite a substantial return. And once again, prices came down, and in October, we had another buy signal in a whole bunch of stocks, and these were stocks that a lot of them could be grouped as high dividend stocks. That's what they had in common. And this one was paying, I think, around 4 or 5%. And so we wound up taking this one here in particular, and as you can see, this one here between here and getting up to the reaction line was only about 8 or 9%. But considering that we wound up getting paid a dividend during that time period, that added nicely. Okay, so what happens is we'll end up taking the buy signal and going up to here. Now we'll get into a little more of the intricacies of this in a bit. Let's take a look. And so what happened was we're in December now, and recently we just had a buy signal in the oil and gas group. Had just a lot of stocks in oil and gas that gave a buy signal. And so this one here was picked as the one to go long, and like all the other times in there, we wound up telling it to the group. And so the target is the Babson reaction line up here. Okay. So the theory is simply that utilizing as little as 25% of the portfolio for each signal, and then getting out when it hits Babson reaction line, it would still outperform the market, because each time you get a signal at a low, you're only in 1 or 2 groups. So you're using maybe 25 or 50% at the most of the portfolio. And considering the fact that when you use 25% of the portfolio, your risk is only And when you enter in a stock, let's say your risk is 5%. So 5%, 20 winds up being about 1.25, maybe worst case 2%. So your risk of your portfolio is only about 2% on the trade, and this seems to work reasonably well. And there's really another benefit to it, and that is that while you know doing stocks is nice and wonderful and things, is this way don't have to do a lot. You can only pick a few that wind up being a member of the group that wind up having a lot of signals. And the reason I use a group that has a lot of signals is because I found from experience, and I know from some big time money managers, that if you can find a group that will move in the new direction and move strongly, that whatever stock you have will probably do okay. And if you can select the stocks that will do exceedingly well within that group, you should easily be able to outperform the S&P. Okay. So I thank you for your time. Let's see. By the way, there are, if you're interested in this kind of stuff, we have several books. These are only really for college students. Give you an overview of some of the techniques. To really get into the techniques themselves, we highly recommend you can't see the full page. Ooh, let's fix this. Just remember power trend investing. We have 3 books that are available right now for college students, really, that give you an overview of the techniques that we use. If you'd like to have some deeper insights, just go to andrewscourse.com, and what we have we have a very nice course to offer you, and that goes into the deeper insights on this. And also, if you're a member of our discussion group, our private discussion group, we'll also let you know what we come up with in terms of what groups we like when the market turns down, and also what stocks within that group that we find interesting, and so that you can draw the lines on them and use our techniques on them and evaluate them yourself. Right? So I thank you for your time, and remember, you can outperform the market. Bye.